Okay, what's up, everyone? Today I'm here with my good friend Ben Sparham, the stock god, analyst. So we're gonna chat about a few things today: markets, prop firms, trading, personal accounts, longer term portfolios. What should you be investing in 2025? But yeah, Ben, if you can introduce yourself, and we'll get right into it.
Yeah, absolutely. I'll keep it short and sweet because obviously some people have seen our content and that before.
Yep.
But yeah, I've been in the markets for over a decade. I run sort of a variety of portfolios. Nowadays, very kind of low risk, sort of diversified portfolios. We run across multiple asset class, stocks, bonds, commodities, currencies. And the idea for kind of the way that we structure things nowadays is very much all about that smoother equity curve over time. We're not looking for these big, crazy, massive years, up years, but then taking on a ton of volatility in the process. We'd rather have better risk-adjusted returns, and that's just a personal preference. Obviously, you can, take portfolio models and stuff, and we'll talk about this in a little bit, and dial up and dial down the risk and stuff like that. But got to make it personal and to you basically. So nowadays a little bit more lower risk and stuff like that. But it's interesting to kind of help and guide people as they come through their journey, and because everyone's going to have different goals. Some people are going to want more aggressive portfolios, and we can help them achieve that. Other people are going to be very similar to myself and want low risk models, and then we can help them do that as well. But yeah, we can talk about how we do all that type of portfolio structuring.
Brilliant. Yeah, I think something that I've been speaking about quite often has been once you make money, for those that do make money, day trading, take it out of your day trading accounts or prop firm payouts, whatever, and actually put into lower risk long-term portfolios. It's something that I've been doing for about 2 years now, 2.5 years maybe. I wish I'd started it earlier. So basically, essentially what I'm saying is I've been taking probably about 70% of my prop firm payouts and personal payouts, withdrawals that I take every single month from my personal day trading account. And I've been putting it into low risk S&P 500, NASDAQ ETFs, as well as there's one ETF in South Africa called the Satrix World MSCI World Feeder Fund. It's basically got like a lot of the tech stocks, a little bit more aggressive. I know 2 years ago it did about 33%. So a little bit more aggressive, but that a lot of the ETFs I've been investing into, and I keep it simple. And then I'll also dollar cost average into some of the Mag 7 stocks. I think that's I think a lot of traders, they think that, and this was me back in the day, that, you're making money trading, you should put all your eggs just in your day trading, whereas all of a sudden you go and tilt, you hit the drawdown of like 20%. Now all of a sudden you've got a way bigger account and you're in a drawdown of 20%. It can kick you in the nuts quite hard. So what are your thoughts on that sort of thing? I know we're going to get into a little bit maybe of why you should be day trading, prop accounts, personal accounts, all that type of stuff. But what are your thought processes on having a long-term portfolio? Should people have long-term portfolios?
Yeah, I'm a big advocate of you should always have different types of portfolios, right? You're going to have some that are slightly more aggressively, more offensively leaning. Some are more defense, essentially. And the reality is, no matter what style of trading you use, whether you're a long-term investor, a day trader, anything in between, market conditions are always going to vary. Different economic conditions, things like that, are going to cause different, market conditions, and therefore different strategies are going to perform better and worse in different climates. Some of them are going to have really good periods, are going to have bad periods, especially when you look at, say, day trading and stuff like that. In order to be able to day trade, you need a certain level of volatility in the market because you need the market to be bloody moving, right? Now, there's going to be times where the volatility and the volume is just naturally lower. And if you're just sitting there trying to day trade because it's the only thing you do, this is why we see so many people. They have good winning patches, then a big losing patch, and they end up a break-even trader, and they've just kind of gone win, lose, win, lose, win, lose throughout the year in these cycles because they obviously do very well when the market conditions are there because they have a strategy and stuff like that. But then they also don't know when to sit on the sidelines because then when the market conditions change, they're still trying to enforce their view and their strategy rather than being able to sit on the sidelines. And I'm a big advocate and a big believer that a lot of that comes down to the fact that if you don't have other portfolios, you haven't got your money working for you in other ways, it almost becomes a bit of a psychological thing that you put pressure on yourself and it's like, I have to trade because otherwise my money's just sitting there doing nothing. If you, even if we look at a very simplistic version, you had an index fund with a bunch of cash in, and then obviously your day trading account. Well, if you were sitting there saying, right, there's no trades this week, it doesn't really matter because my index fund's been running along and it's maybe up 0.5% this week because the market's up. It just didn't present me any intraday opportunities. It's very easy then to kind of sit on your hands a bit more when you know there's some money working for you elsewhere. So in my opinion, it always makes sense to have different types of portfolios, some that are a little bit more passive, for lack of a better wording, like they're low maintenance. and then some that might be more obviously actively managed as well. But if you have that diversification, firstly, you're then diversifying between different strategy performances. So maybe Q1 of this year, one strategy doesn't perform as well, but the other one does, and it kind of balances you out. But also it helps you sit on your hands sometimes, especially when you're looking at active portfolios. There isn't anything really there that's an A plus setup, as some people refer to it. It's easy to sit on your hands if you've got money working for you another way. So I always think, and I'm always a big advocate of, you should definitely diversify a bit and have different portfolios there, 100%.
Ben was telling me before we started recording this morning that his A+ investment portfolio this year is to buy Dogecoin.
Don't give away the secrets, James.
No, I think that's really true. I think for a lot of traders, particularly for me, I know, Ben, you more like a longer term investments portfolio, but you have been doing some day trading on the side, more maybe not call it scalping, more day trading, and that's something that I've actually been focused on. I actually was looking at some of my stats from last year. I've made a video about that, so I'll put the link below to that video as well, and I will put Ben's channel and socials and everything below as well. So make sure to give him a follow. But I was actually looking at some of my statistics, Ben, and a lot of my hold times were actually quite long. Like I'm not long compared to some guys that are like literally in and out trade within like maybe 10 minutes, whereas I'm actually been holding for a couple of hours. And I think it's been quite nice to actually be a little bit more slow things down. I haven't really been dropping in the last month. I haven't really been dropping below the 15-minute time frame, which has been quite nice for me, because I think, as you mentioned, it's good to have other things to do. I think making content's one, building a personal brand is another. And this is always also, what do you say to guys that are like, oh, James, you're making content because you don't make money trading, or Ben, you're making content because you suck at investing, whatever it is, these clowns. What do you say to guys that are going to say things like that?
I always just say to people things like, okay, so the guy that works at a hedge fund then that's worth a few million quid, are you telling me that he's meant to stop trading other people's money because he's got loads of his own? Like there's always other ways of leveraging your skill set, and you do it in every other industry. So why would trading and investing be any different? The reality of the situation is, if you have other income streams, you're able to not then lean on your trading and investing profits. You're able to reinvest them, compound them, and build your wealth faster. Now, obviously, if you trade and invest, then an obvious skill set to lean on is maybe having some sort of service or mentoring or whatever it is in the space where you make money in another way, basically, right? So this idea is just ridiculous. Plus, if nobody ever taught anyone anything, how on earth would anyone learn how to trade and invest? It doesn't really make any sense, right? So I think a lot of the time people, they tend to jump on that sort of bandwagon. I think generally after, they've paid some online guru $1,000 for their course, which is just baby pips rehashed, and then they've just been scammed a few times, and then they're like, oh, everyone that sells a course is a scammer. No, you've just, rather than actually using your brain and asking for a verified track record, you went and bought his course because you saw him put a nice Rolex on Instagram, and now you're wondering why you got scammed. So it's just like, sometimes people got to look in the mirror, but they tend not to. They tend to obviously put that outward. So it's just logical to have other streams of income, basically.
I agree. I've really been enjoying actually embracing in the last, because I think a lot of the time when I first got into the space, I actually was just focused on my trading. And what I actually found was my mental health actually took a big dip. You can't be staring at charts literally 20 hours a day. I'm about to actually be a dad in the next month. We're filming this currently on the 13th of Jan, 2025. My son's due in beginning of Feb, 6th of Feb is due, but obviously could come earlier or later. But I've actually found myself not wanting to be, and this is why I'm looking at like a 15-minute time frame or higher, not wanting to be on the charts as much. Also from a day trading perspective, I've been listening to quite a few interviews and just looking at different perspectives on like interviews with FTMO and what are their big traders doing. Have you seen, certainly what I've seen, just speaking from a day trading perspective, the more trades you take, actually, Ben, the more money you pay into the rake, the brokerage firm, because your commissions are going to eat you up and your spreads are going to eat you up. Whereas if you take, let's just say you made 1% in a day profits, but you took 10 trades to get there, your commissions could maybe eat that, and you might only make 0.5% in a day, compared to if I took one trade in a day and made 1%, I'm probably gonna my commissions will maybe be less than 0.1%. So just something that I've been seeing, and it's quite interesting, is like a lot of guys are saying like most traders that are actually making money, especially in CFDs, it's silly to scalp CFDs because you're going to pay high commissions. It's rather widen the stop loss, hold it for a couple of hours to a day, and see if you can make money that way. So just something that I've been wanting to slow down in my own life as well. And also, as mentioned, in terms of the long-term portfolio, is having that longer-term portfolio. So what I do personally, and I know last time we had a call, and I actually I got a call from one of my mates who's a financial advisor, because I don't know if you recall, Ben, I said that you could just be investing into the S&P 500. You don't need to pay these financial advisors these percentage cuts. And he's like, yes, James, I agree with you, but some guys don't even know how to get started. I said, I understand, Thomas. His name's Thomas. I said, I understand, Thomas.
Put him out of business.
Yeah, put him out of business.
But it's true, right? And it kind of ties in with what we said earlier on, is that, you know, most people would be better off doing that, because, you know, they're just sitting there, you know, let's say they back test a strategy on euro dollar intraday trading, blah, blah, blah. And they're like, oh, you know, it's generated 30% on average per year. And it sounds great on paper, but they haven't factored in any kind of slippage in high risk events, additional market volatility, brokers, you know, messing with them in some way, shape, or form. They haven't allocated for holding fees, commissions, spreads, all these sorts of things. That 30% a year all of a sudden is 8% per year, because there's so much trading volume and all these different things and costs add up. And now all of a sudden they've underperformed the index again. And this is one of the advantages that an index investor has. They're literally just buying the index and doing nothing. So they're not racking up fees. And with most places like a Vanguard and something like that, you'll pay like 0.1% per year commission or something. And so therefore it's like impossible to beat from a commission aspect. So by default, you know, in order, let's say the S&P has gone up 10%, you know, in that year, if you're an active trader with a fairly decent, you know, trade volume, you've probably got to make, from a gross aspect, close to 20% to have any chance of actually outperforming. And there aren't many people in the world that have averaged 20% per year over a long period of time. Plenty of people have that over, you know, a 6-month period, you know, 12-month period sometimes, because of course market conditions present themselves. I saw an interesting statistic the other day, actually, that, you know, we know the S&P average is about 9.5% per year, you know, with dividends reinvested, etc. But if you actually take out the losing year, the average up year is 21%, right? Wow. So when you actually look at it like that, obviously it balances out over time because of the down years and stuff like this. But the point I'm making there is, if you've got an up year in the market, it's fucking hard to beat if you're actively trading from an absolute return aspect, because the average year is up 21%. Now to outperform that, actively trading, you've got to be looking at a gross of probably 30% plus. And like I say, they just don't exist, those types of traders, or very few of them, right? And I think that's where we have to be careful as well, is because people are sit there and say, oh, but I heard about XYZ trader and he did that. Okay, but you found one guy out of millions of people on the planet that trade, right? That goes to show how difficult it is. So sometimes I think people have also got to kind of factor that in and go, is it worth all the additional stress? And even if you outperform the index, let's say you make an extra 1 or 2% per year, but the difference is that you've had to sit there in front of a screen for 40 hours a week, and you're doing all these things. You sit there and go, is it worth it?
Yeah, I agree. It's and that's where you know, you got to weigh up. That's where I've also been like, yeah, I did really, really well last year on some of my more aggressive personal accounts, and we'll get into trading personal accounts, prop firms, and that, everything like that. You also got to have different goals for your accounts. You can't just have one account. I think you should have an aggressive account, a slower as a day trading account specifically, the slower account, and then maybe an account that you're just looking to make 10 to 15%. You want to keep it in your bank account, but maybe you still want to trade it. Okay, look to make 10 to 15% from, and another account that maybe you more moderate account, 20% plus would be great. And then maybe more aggressive account where you're looking, you're going to have bigger drawdowns, of course, as well. So I think it is interesting from that perspective. But certainly for me, this year, my goal is to just slow things down. And I don't want to be taking 20 trades a week. I want to be taking literally 5 to 10 trades a week, and hitting it harder on those better days. And if sometimes in a week I don't get it, then so be it. And that's where I want to be at with the prop firms. Some of the prop firms that I'm going to be focused on this year is going to be FTMO. Of course, they're always going to be the best one. I want to get back to max funding with them, and then as well as I am trading with Hydra. As I said, I've just literally got my first funded account with them over the line, and after failing a few, so that was obviously quite neat. But what are your thoughts on prop firms? You've obviously seen the big change. What are your thoughts on prop firms? How should people be using them?
I mean, for me, I always say the same thing to people. It's like, look, if a trading style that you use suits some prop firm rules, because obviously lots of them have certain, limits and sort of
Yeah.
holding periods and around news events and blah blah blah. So it has to be something that obviously suits your strategy. If you've done your research and FTMO or whatever it is, that particular account type, yes, okay, you're not going to get screwed. You're not going to breach any rules of your particular strategy that you're using. Then by all means, go ahead and use them. But you should be using them as an additional extra. And I think too many people see them as a golden ticket to changing their life or building their trading career. The amount of
Yeah.
people that will sit online and try bragging and claiming, at least, that they, $1 million in funded, $2 million in funded, but they haven't even got $5,000 in a personal account is quite frankly laughable, right? Because you sit and you say, well, firstly, if you really are funded and you really are getting payouts like you say, what on earth are you doing with the money? Why are you not reinvesting it into your own infrastructure essentially and setting up your own wealth base and in terms of other investments away from that? But also, secondly, it makes you sit there and think, well, you're probably just lying in the first place because you're probably either not funded with that amount or you've got a marketing account that makes it look that way and you're probably never actually getting a payout. People will sit online and show their rise payouts or whatever, but plenty of affiliates get paid through that as well. So they're not actually withdrawing profits from their profit accounts. It's just how they're getting paid their affiliate commission. So what I would say is try and block out the noise a little bit. Do your own research, work out if they are for you. And if they are, then leverage them, use them. But then it should, like I said, it should be an extra. You should still have personal accounts. You should have personal investments, all these sorts of things. And then that way, you're always protected by where if there's ever an issue with that particular prop firm that you're using in terms of payouts or regulations come in 6 months and it changes the industry and you can't use them anymore or, whatever. It yes, it might sting slightly, but it's not going to be the end of your trading career. You're not going to suddenly be sitting there going, oh shit, I've now got nothing but a couple of grand in a personal account and I was funded $3 million yesterday. That should never ever be the case. So I think, by all means use them, but be sensible with them and use them for a tool to build your personal wealth, not sitting there thinking that there's some get rich quick scheme.
I also think some traders treat those personal accounts, the proper accounts, like the be all and end all. And I actually started my trading journey with trading personal accounts. I had my first 100K year trading a personal account. Well, not all my money was private investors, but personal account was in a brokerage account. And then I started to see, okay, you can actually leverage these prop accounts. I think too many people put like they'll come in and trade. And this is to me at a certain stage as well. Like I would come in and try and pass an account and take 6 months to pass an account, where I probably would have been better off putting that amount of money into literally probably an index fund, would have made 5-6%. So I think if for you guys watching, what I've been doing is I've been taking a set amount of dollars every single month, call it $500, and I've been buying 50K accounts, call it whatever you can get for $500, and then trying to pass them as quick as possible. That is what I've been doing because I want to leverage them, get it to the funded stage, and then I'll tone down the risk just to get my payouts back. I think, but then once I'm getting those payouts, I'm putting them into a long-term fund, and call it gambling, call it whatever you want. I'm trying to utilize. I don't want to be sitting in a prop firm account for 6 months. I simply don't want to be doing that. That's
it's exactly that. And I think this is always the thing, right? You've always got to make sure that you kind of understand that the game that you're involved with in terms of how they're set up. The reality is that most prop firms, or the vast majority, they're not set up for you to fail, to succeed. They want you to fail because that whole business model is based around that. When somebody sits there and claims they're being A-booked, they're probably lying, because the regulatory aspects around it for giving somebody real capital to trade and all the rest of it, it's just such a nightmare that they're not going to be doing that with some random bloke that bought a challenge account. So, at the end of the day, you've got to kind of make sure you take it as it is. Like we said, leverage them. But don't make them the be all and end all. Your own personal accounts and stuff like that should be. And you can normally, identify the bad actors in the space very easily. If someone's sitting there saying that they're trading props only, and you say, why are you not trading personal accounts? And they're like, well, why would I risk personal accounts as well? It's like, well, that doesn't make any sense. That tells me two things. Because with trade copiers nowadays, you can very easily just link the two, use the same strategy.
And you can turn it on and off.
Exactly. So that firstly, that says to me, A, either you're just not profitable as a whole, right? Which is why you don't want to put your own money on the line. Or B, the way you're trading those prop accounts is not actually properly trading them, and you're just punting on them, basically, hoping for a payout, which is why you also don't want to put your own capital on the line. So, people will sit there and say that, they're using a prop account because it's, they want to get access to as much capital as possible. But if that was the mindset, you'd be putting your own money in everything. You'd be putting all sorts of money on the line because you know that you're profitable and you want to get as much invested in the market as you can because you know you can make money. So a lot of the time, it's what they say doesn't actually line up with, what they're actually
do.
Yeah, then
Yeah.
you've got to kind of ignore all of that noise in the space, and then just sit there and say, is it right for you? And now, how will I actually really maximize these to really benefit from them with regards to personal accounts, personal investments, all this kind of
Yeah.
stuff off the back of it?
And I agree. There's nothing actually better because obviously from a personal account, you take a withdrawal. If I want to take a withdrawal right now, I'll go log into my regulated broker, not some clown brokerage firm. This is again, I get asked a lot of questions, and you can go hit withdraw, and it literally will probably be my bank account by tonight or tomorrow, right? So
Mhm.
that's the beautiful thing about a personal account. And I think a lot of times I get asked actually, James, how are these guys actually making their money? Why are they driving these fancy cars? First of all, it's probably all rented. But even if it's not, let's just say it's not.
Mhm.
What these guys do is actually quite sad, Ben. Is that I had a guy the other day ask me, and he lost some money to it. These guys open up their own brokerage firms that are unregulated.
Yeah.
And then all of a sudden they shut it. I mean, I know you're going off about this guy, one guy online. We won't bring up his name, but basically, they open up their own brokerage firms, unregulated. They get 10,000 people to deposit $200 each. Now, you do the math, it's a lot of money. And all of a sudden, after 6 months, they've got enough deposit in. Let's just say they've got $10 million to deposit into their unregulated broker. They close down shop. Boom. Are you going?
Yeah.
Is everyone going to go and get their $200 out? No, it's going to cost them more in lawyers' fees to get the money back. So they just leave it, and the guy ends up walking with $10 million. They come back, they leave, they disappear for 3 years. They come back, they do it again.
Yeah, exactly that. And it's the same old cycle repeats. And I think this is why people have to be very careful what they're consuming online. A lot of the people, unfortunately, that end up big online, they've done so through showing lifestyle fake stuff, which has then
Yeah.
basically appealed to the appeal to the masses because, what they're appealing to normally is that people, they want to get away from their situation in life, whether that's a poor financial situation as a whole, a job they hate, whatever it is. And so they're
Yeah.
looking for a way out. And so a lot of people prey on that by basically posting all this fancy stuff, trying to glorify something that isn't there to be glorified. When you, at the end of the day, when you see the real professionals, the hedge fund managers and stuff like that, the guys that are making serious money, the guys that are worth hundreds of millions or billions of dollars, they're not living that, they're not posting like that or showing off and flexing their wealth in that way, but they're worth, a million times more than what some of these gurus online are showing you. So, you've got to think about it logically, and you've always got to be careful and just always make the decisions that are genuinely in your own best interest by doing plenty of research first.
Yeah. Okay. Cool, Ben. So there, obviously, we've covered quite a few topics. We want to keep these between 20 and 30 minutes, guys. Any thoughts or where can we find you in 2025? Any goals for 2025? What are you going to plan for this year?
You mean in terms of, sort of
Trading,
markets?
business, anything like that?
Yeah, so from a business aspect, we've obviously got the virtual trading floor that we run. So the idea is there that we've created a platform by where there's courses. You've got the online education and everything there. We've got the community there. We run live streams. Everything's in one place, basically one membership. You haven't got to go pay thousands of pounds. It's just a monthly subscription as long as you need it, and that's there to obviously support and help people along their journey up until that they feel comfortable to be able to go and control things on their own, or they just might stay part of it because they enjoy the community, of course. So that's, on that side of things. And in terms of like allocations, we're applying ourselves in the same old way. The reality is that we don't know for sure what's going to happen in markets. So we have to kind of be prepared for all scenarios. We have, long only 100% stock focused portfolios, which are there designed to be a bit more aggressive and to outperform over the next sort of 10, 15 years. But we know that they're susceptible to larger drawdowns if we have the right conditions, economically, to have larger, drawdowns and corrections. And then to mitigate that risk along the way, we also have multi-asset portfolios. Whenever you look at it, money always flows somewhere. So no matter what's going on in the world, how bad things seem, within the economy or the market or whatever, you'll always find that something's performing somewhere. The money is going somewhere, right? Even if you look at, say, like a 2022, when most things were getting crushed, the stocks were down, bonds were down, all the rest of it. Then you look at commodities and the energy sector, that did very well because it was something that benefited from the high inflation environment. There's always going to be something somewhere. So the idea is that you're diversifying yourself, to basically be prepared for different economic conditions, economic growth, contraction, inflation, deflation, etc. And then you're kind of, there's various ways that you can do it. You can volatility weight yourself. You can go equal weighted. Depends on how you want to do it. There's various different methods, obviously, and also how aggressive you want to be. But the point and case being there that you're diversifying, and then the idea is that you're sitting there saying, look, I'm not going to try and predict the future. I know that I own a bunch of assets that will all go up over time, but they have lower levels of correlation to each other. So now what I'm going to do is I'm just going to kind of let it do its thing. If we have an economic downturn, a market downturn, whatever, okay, cool. It doesn't really matter. I'm not going to try and predict the future. I'm just going to, kind of be balanced in a way that I know gives me historically the correct level of volatility that I'm looking for in this portfolio. And I can now just let that run and do its thing. So that's the idea and what we're looking to do, be diversified in our approaches and allocate accordingly. And then whatever the market presents us this year, we take the rough with the smooth. And we know that not all strategies are going to perform all the time. A good example of that, I've got an eToro portfolio that's been public for 5 years now. It's all fully verified. Had a nice big year in 2023. We was up like 24 or so percent, bearing in mind that this is a multi-asset, unleveraged, long-only portfolio, right? So it's not designed for big returns. But then last year we made money, but it was only about 5.5%. But it's a very kind of low-risk, unleveraged portfolio, like I say. So it's not always going to perform the best. But then we've also got other portfolios. We've got a concentrated stock portfolio that made 46% last year. We've obviously got our index funds that are up about 23.5% last year. So we don't need every portfolio to go and smash it out the park. It's not going to be like that. And that type of portfolio will also have its day in the sun where, if you get a market correction, those 100% stock portfolios are going to have a much bigger drawdown compared to the multi-asset portfolio. And that's when that will shine, right? So the money's allocated in different ways. And that's how we're always trying to look at it and sitting there saying, look, we can't, if we be prepared for everything, then it doesn't matter what the market and the world throws at us, right? You can't always time and predict everything perfectly. So it just depends on what level of risk you're happy to take and how often you're willing to be wrong, basically, if that makes sense.
Sure. No, 100%. Okay, so I want to, because I've been trading quite a bit of stocks recently as well. By the way, I've actually been trading quite a bit of multi-asset watch list on my day trading side of things. I've actually been trading a little bit of the DAX, the US indexes, a little bit of Bitcoin as well, some currency pairs, mainly the yen crosses like EJ. And then I've also been looking at some stocks, namely Nvidia, Tesla, Meta, and Apple have been performing for me quite nicely on the day trading side of things. So I'm actually watching quite a variety. I think it's quite, and this is for the day traders that are listening, I think it's quite silly to actually say, I only trade Euro USD. And I'm like, dude, Euro USD,
the range of volatility is terrible, yeah.
Yeah, you're not going to really get moves every single day on Euro USD. I would rather watch, and I know guys like Tom Dante do this. He says, when someone asks him, what do you trade? He says, I trade everything. Because if gold's going to give him an opportunity, he's going to trade that. If Bitcoin's going to give him an opportunity, he's going to trade that. If Euro dollar is going to give him, he'll trade that. So it's like, I think it's good that that's what I've been saying. No, I'm not trying to say I'm watching 50 different tickers. No, I'm probably watching about 10 to 15. And I think I know what I'm looking for. As I said, I've slowed things down for a high 50-minute time frame and above. And I know what I'm looking for. I think for you guys that are, two things. For you guys that are only trading Euro USD, try add in some other asset classes like an index or a stock. Try add in, and also for the guys that are trading off the 1 minute time frame, just zoom out a little bit. I've actually found myself, I don't do well with having to stay like this at a chart, make 5 good decisions every single day. I'm not going to do well. I know for a fact that because I've tried it and I did it successfully for a couple of years. And then all of a sudden I started find a little bit of drawdown and I started to realize, geez, in those drawdown periods, I make even worse decisions because I don't do well watching a 1 minute time frame. So there's some tips for you. I want to ask you, Ben, one stock in 2025 that you would buy, what would it be?
So I always like to focus in on market leaders, companies that are incredibly well positioned within their industry and very unlikely to be displaced. And if they were, it would take a number of years, right? So, when we're kind of factoring that all in and you're looking at relative value and things like that, I look at the likes of, things like Google at the moment, and I sit there and say, trading at I think they're a multiple of like low 20s at the moment still, but they, absolutely dominate online search, the online advertising space, all that kind of stuff. Yes, there's always that element, and people always talk all the time about regulation changes come in and blah, 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 blah. But we're talking about, one of the biggest companies on the planet that has hundreds of billions of dollars behind it and absolutely dominates its space. For that to change anytime, it's going to probably take 5 to 10 years at least. Sure. And I look at that and I look at it compared to some of the other Mag 7 stocks. And I think, that looks the most relatively undervalued compared to them. But it still has a positive trend to it. When you look at it, it had a little bit of a drawdown 6 or so months ago, but it's been performing quite nicely as they've continued to absolutely crush their earnings, and the reality of the story continues to play out. So for me, I think you get good kind of risk to reward as an individual player if you're looking at the likes of Google. But of course, you want to diversify that into a portfolio, right? Don't put it all on Google now, because I've said that.
No, that's exactly what I'm going to do. Now, I'm just actually seeing here Google, and I can actually let me share my screen here for you just before. I can actually see Google here is actually up in the last year 33%, and we're trading at 193 dollars per share. So okay, I'm gonna have a look at this, Ben. I definitely think I was reading the other day, some people also believe that where was it? Amazon is also quite undervalued at these levels. What do you think of Amazon as a stock as well?
Yeah, Amazon's another one of those. When you look at it, even if you just put yourself from a consumer aspect, right? And you just sit there and think, the first time, if you want to buy something online, your default thing nowadays is to just look on Amazon straight away. Their customer service is so good, they're logistically so good. They can get, the amount of times I've ordered something early in the morning, it's turned up the same day. And things like this, rather than having to wait, 3 to 5 days or something like some other companies are. Then if there's an issue with something, you can just send it back so easily, or they'll just refund you instantly and just be like, don't worry about it. They're just so good from a consumer aspect. And so ingrained in our life now that it becomes very difficult for anyone else to be able to come in and obviously push them out. And then, of course, you've got Amazon Web Services and all these other elements on top nowadays that also make them billions of dollars in revenue every year. So, I think it's a sort of company that definitely has its place in a portfolio, and it's definitely well worth holding. A very similar sort of thing, like I say, to Google, in the sense of it just absolutely owns its marketplace. And they're the type of companies that I like. If you've got something that's incredibly dominant in its space, that it's very difficult not to perform over time. But there still needs to be some fundamental value in there. Make sure that the company itself isn't deteriorating from within or making bad decisions in terms of management and stuff like that. But yeah, I think those types of plays are always the sort of ones that you can rely on nicely over time.
No, nice. Okay, cool. I think this was good. This has been about 30 minutes. I want to maybe do a part 2 in the next couple of weeks as well. We can speak about maybe some dollar cost averaging, plans into index funds.
Yeah, about some passive strategies and stuff.
Maybe some passive strategies for guys that are, not as smart as you, more for like the dumb guys like me that need like a dollar cost average plan. I can share what I do. Maybe you can give some tips on what you would do for guys that can't watch, that don't want to watch the markets 24/7, that just would like to, okay, I've got $100 a week and put it into the markets as a passive type of investment. Maybe we can speak about a few actual steps like that next time. So I think, stay tuned for a part 2, guys. And then we actually did do one a couple of months ago. So make sure to go check that out on the YouTube page as well. I'll put Ben's links to socials down below, and then we'll see you for the next one.
Yeah, cheers, take care, man. Speak to you soon.